I am very excited about today's podcast. I am kind of bringing you guys into my world a little bit. I had just finished refinancing my own personal house, and I used a loan product that I'd been researching for probably over a year. Bounced around a couple of different loan officers, finally met a loan officer that was a really sharp guy, very good at explaining things to me. And through our conversations, I learned about some additional loan products. And so I'm excited to have finally closed my refinance with him and with his company and kind of discuss and dive into a little bit more of the other products they offer. And so I'm going to introduce Harrison George, who is with CMG Financial. Tell me a little bit about yourself. How long have you been doing lending and how long have you been with CMG?
Yeah, perfect. So my name's obviously Harrison. Thank you very much for having me here. So I have been with CMG since I believe 2015. Started in the lowest of low positions, just cutting open mail and scanning documents, and have worked kind of through a myriad of positions at CMG in the lending sphere on the loan origination side of things. I've been doing this since March of 2018 and have been doing that out here in Boise, Idaho.
Go back a little bit. I know there's a million banks, a million mortgage brokerages. Is CMG a brokerage? Are they a bank? Are they in the middle? Tell me a little bit. What is CMG?
Yeah, so CMG is kind of just like a combination between a bank and a mortgage. It's really just a mortgage company. We're not a bank. We don't have a depository institution or anything along those lines. Now, we do partner with depository institutions, as we'll get into about that all-in-one program. But we have relationships with Fannie and Freddie, so we work with them direct, and we work with different housing authorities throughout the United States directly, which ultimately means we underwrite the loans ourselves, and then we package them up and we send them off.
Okay. So you can do all the normal secondary market conforming mortgages along with some additional stuff that sometimes only banks can do as well.
Correct. Yeah. So we do all the standard conforming loans. We deal with jumbo products as well. We deal with down payment assistance programs throughout the United States, with kind of one large program that deals with the blanket United States, and then each state or a large portion of states have their own specific housing program.
Yeah. Okay. Cool. And I think one of the things that I think I found CMG so interesting and you so interesting is you want to work with people who can solve problems. And so as I was talking to you, you would come up with a thought or think of something or say, we have this, or have you heard of this? And so we've got a local mortgage broker that we kind of partner with locally that does a great job doing that exact same thing, helping clients solve problems through the transaction. And if you can be a good problem solver and have a lot of resources, tools, products, I think it can make you a great loan officer. So you've shown that to me so far. So I kind of want to jump into, and I'm going to try not to talk too much, but I want to kind of set it up a little bit. Just refinanced my own personal house. At the time of this recording, at the end of September, rates are at the highest they've been in 15 years. They're at low sevens. Everyone and their mother refinanced their house 18 months ago, right? I didn't, for multiple reasons, mainly just because I was busy, stupid. And then I refinance them now when rates are crazy, right? So why? That was everyone's probably thinking that was dumb. So the main reason is because this product is a very unique product. I'd never heard of it. About a year and a half ago, I learned about it. And the more I learned about it, I thought, well, how does that work? And then I'd ask questions and I'd think, okay, well then how does this work? And then I dig into it. It's a super, super cool product. So the main overarching thing that I found so interesting is it's a home loan on your primary resident that you can acquire for as low as 5% down, I believe, right?
10%.
Okay, so as low as 10% down payment on the appraised value, but it is also a line of credit built into your primary residence. So if I live in a house for 5 or 10 years and I pay down my principal for 5 or 10 years, I can't access that equity without getting a refinance or a line of credit, and those cost money, $2,000 to $6,000. With this product, every time I pay principal down, I have it available to me in a line of credit. For any reason, for repairs, any unexpected expenses, vacations, whatever it is, you have access to that equity without having to spend a ton of money refinancing a property. And so that was the thing that I found super, super, super interested is I don't have to go give the bank more money to get my own equity, if that makes sense. And so now that I've maybe told you too much, tell me a little bit about it.
Yeah, so kind of as you indicated, it's a mortgage and a HELOC, but actually, kind of more importantly, it's a checking and savings account that we create for you that's linked with your mortgage. So, in a traditional 30-year mortgage, the way that it operates is it's a high interest first, low principal payment. And on the side, all the way over here, you have your income that's going into this account, and all of your expenses are being paid out from here. Well, one of the cool little statistics that we're trying to take advantage of is over the course of a 3 to 5 year time frame, most households in America earn enough money into their checking and savings account to have paid off their mortgage. Now, obviously, if they didn't spend their money, it's a whole different scenario. But that cash flow going into your account in a traditional banking environment really doesn't do anything for you. You're earning nothing on it. It's just sitting there, and then you end up depositing it somewhere else or expending it or doing whatever you want with it. In the all-in-one, as somebody earns their money, that money is going against their mortgage instantly. The day that they earn their money, their mortgage balance has gone down. And by taking advantage of your income going against your mortgage, your payment on this loan is calculated off of what you owe on a daily basis. So if for whatever reason you go, hey, I have access to, I have a lump sum of money, my 6 months of money that I have sitting over here. Well, it's really doing you nothing other than providing you with a sense of security. What if you could have it provide you with a sense of security, but have it also save you $300 a month on your mortgage payment? What could you do with $300 a month? That's a car payment at the end of the day. Or it's $300 more that's sitting against your home, paying it off, which by utilizing a program like this, you reduce what you spend in interest, meaning you keep more money in your pocket, which results in a myriad of solutions, one of which being the payoff of your home between 5 and 8 years. Without changing how you spend your life.
Yeah, that's what the calculator we'll jump into here in a minute. The calculator just does not calculate in my head, and I have to really talk through it, and that's what's so interesting. But kind of back to what you said, most people, hopefully, not all, have a savings account. It's got 1, 2, 3, 20, 30,000, whatever you have sitting in there. And the reason you don't just take that and pay it towards your mortgage is because 1, your payment doesn't change. And 2, you lose that money. You can't ever access it again. And
unless you sell it or refi, yeah.
Unless I sell it or refi it, right? And so with this product, you're basically saying, get rid of the checking, get rid of the savings. Just use our checking and savings, and your rainy day fund, your income twice a month, or if you get commission checks, whatever, all goes into this one account, and it reduces what the interest is applied towards each day.
Every day.
Sitting in it.
Yep, and it adds up over every day, and then it pays out every month. One of the things you did say, though, is this is getting a little more granular. You don't really close out your old bank accounts. You keep them open because this is a depository institution. It's mainly done on this or on that, on your computer. But if you, for whatever, needed to access cash, well, then you could just transfer money from your bank account, in the all-in-one bank account, into your Wells Fargo or whatever, and then you can go into your local institution and get physical cash.
Okay. But the account comes with debit cards, checks as well. So I can, if I wanted to close out my accounts, I could.
You certainly could, exactly.
Yeah, which is what I was planning on doing for no reason. But another minor thing that I think I want to mention, there's no escrows with it as well. So it's something you pay your own taxes, you pay your own insurance out. So there's a little more discipline, I suppose, through that process required. And essentially the way the payment works is at the end of the month, it's accrued out each day, adds them up at the end of the day or in the end of the month, and then draws it out of your checking account.
Exactly. Yeah, I worked on like a very simple 30-day time frame calculation that I can really explain this on a screen share shortly.
And that's kind of the thing what allows, and we'll jump into the calculator in a second, but what allows you to pay a 30-year mortgage off in like 6, 7, 8, 9 years, which I think is kind of what most people fall into, I think. So, if I told you could pay your 30-year mortgage off in 7 years, you'd be like, "How? That's impossible, right?" Yeah. And it's the fact that interest is accrued daily and then paid at the end of the month, and you have normal money flowing in and flowing out every single day. And so if you get your paycheck on the first of the month, it sits in there till you spend it, right? But while it's sitting in there, it's reducing what you owe on your mortgage.
Yeah, you don't spend all your money in the day one that you earn it.
Most don't, right?
If for the individuals that this program would really be advantageous for, if you made 10 grand today, you're not going to go, great, and pay it all, everything off, you're going to go, okay, great. Well, I'm going to spend money on my credit card. I get gas, going to go get dinner with the girlfriend or wife, diapers, whatever, and then go, okay, great. It's the end of the month. Let me pay my bills. And that entire time, that 10 grand's been sitting against your mortgage.
Yeah, and something you told me that was interesting, and I've done this for a while, but when you apply it to this new product, works even better. And I think a lot of people in real estate that I've talked to have done this, where they use a credit card all month long, and then for benefits, flyer miles, all that kind of stuff, and they pay it off at the end of the month, or continue a balance, whatever. But if that's what you're doing, all your income just sits in your bank account all month, and it's helping you reduce what you owe on your mortgage payment, and then you pay off the credit card, then more money comes in, sits there for a month, then you pay off the credit card, then more money comes in. So it's just, that's how it allows you to pay off in 7 years versus 30 years or something.
Exactly. Yeah. And I mean, in reality, one of the statistics is most people will refinance, sell, or do a financing transaction about every 5 or so years. So imagine if you could spend significantly less in interest in 5 or 7 or 8 years, pay your home off, build this big equity bucket, and then roll it into your next home. That could allow for you to kind of do the same thing and build generational wealth, as opposed to always being stuck into this. The first 2 years that you have a 30-year mortgage, you're paying pretty much just interest, which is like really no difference than paying rent. I mean, really generating much equity in your home with your payment. Kind of flip that script around. Let's let your money work for you first, and then pay interest second.
This qualifies as a conforming mortgage, or
Well, it follows conforming guidelines.
okay.
It follows Fannie's guidelines. However, it's not a Fannie product.
It's not sold on the secondary market. It's held by one of 3 banks, right?
Correct.
Talk about that for a second.
Yeah, so I guess there's more than just 3 banking institutions, different investors on the back end side of things. So we're the mortgage company. We deal with the actual loan, and we partner with the actual banking institution, which is where the depository institution is. So that's the individual that once the loan closes, when you go and call them, hey, I was curious about this, you're talking to them because they're the one that's dealing with the money coming into the account. One of the banking institutions is called Merchants Bank of Indiana. And it's an online bank. They do have some locations scattered out throughout the United States. The other one's called Western Alliance Bank, but it's the banking institution is North Point. And then there's some other small institutions called Key Point, a couple other ones. There's a unique loan that Texas has a whole different legislation behind it, and there's kind of a whole different story about Texas. But the 2 key players is that North Point and Merchants Bank of Indiana.
How did this come about? Did CMG look for investors to hold these mortgages, or do these banks come to CMG, or do you know how it was born?
This loan's actually super popular in Australia and New Zealand, and even in Europe. They're called offset accounts and sweep accounts. So the founder and CEO of CMG, Chris George, he ultimately ended up going down to, I believe it was Australia, ended up kind of learning about this financing product, made a couple different trips down there, understood the product kind of in and out, came to the United States. There was nothing here like that, and ended up just saying, well, I'm just going to create it. So we developed the whole procedure of the daily sweep function and kind of taking care of the whole program legally in the United States with our legislation, and then approached a bunch of different banks and was like, I got this crazy idea. I mean, that's kind of really a shortened down version of it, but ultimately, he was like, hey, I have this opportunity. I think this is going to be revolutionary. And then the cool thing about CMG is we don't post advertisements online. We don't do any of that stuff. We just hopefully try and show, hey, we're not actually trying to do a bad job. We want to solve problems, and we're wanting to work on the hardest deals first, because those are the people that ended up getting neglected. So it's kind of nice to be able to solve those problems, like you indicated earlier. He saw a problem with higher interest rates and was like, okay, well, how can I solve this? And that's the interesting thing about the all-in-one. The interest rate number itself really isn't that influential. Yes, it does have influence, but what the most influential part of this product is how much money you retain at the end of every month. It looks good at 15% of your income retained, even better at 20, even better at 25%. Anything above that is just saved dollars in your pocket.
Yeah. Why would a bank want to do this? If the secondary market and investors are getting fat on these 30-year front end loaded mortgages, why would a bank even do this? What's the benefit? I mean, are they getting, is the credit going towards their deposits so they can lend more? Like what's,
Yes, that. And on top of that, I mean, at the end of the day, these banks provide warehouse lines, which is obviously what they're lending out. By allowing for them to provide warehouse lines and provide this product, somebody like you is going to go, hey, I have 100 agents that could hear about this. Let me tell them, oh, that's super awesome. I have a client that's going to be perfect for this. Oh, shoot, this person's credit's not 700, it's 680. But if they go through this procedure, they buy the home and they use me because we've already got everything done and qualified. And then in 6-12 months, after they get their scores up and all the other requirements taken care of, they refinance into this product. Well, I just generated technically 2 deals, but one of which was a conforming loan that is allowing for them to, the warehouse line allows for us to utilize their funds, it works with them, it generates additional business, gets us in front of other people. So it is something that's kind of like, I'm okay taking a half a step forward with the intention of taking a jump, or sorry, I'm taking a half step back with taking a large jump forward.
Yeah. When times are great anyway, like they have been the last several years, banks run out of deposits, taking your money and loaning it out, right? So if I put $10, $20, $30,000 into my credit account, right, then that's $30,000 more they can leverage and loan out. Are they able to treat that as a deposit?
I'm not 100% sure on that answer, but I would presume so. It is a bank account at the end of the day. It's your checking and savings account.
It just, the only thing unique is it sweeps into a loan at the end of the month.
Yeah. Yes. So you'll get a checking account. It'll say checking and it'll say $0. And then if you earn, I got easy numbers. If you earn $10,000, that goes into your checking and savings account. At 11:59 every night, your checking and savings account will go to 0. And that money will go against your mortgage into your mortgage balance account. And now that will go down $10,000. So your checking and savings account, unless money's deposited that day, will show $0 at all times.
Okay.
It's weird seeing it first.
Wait a minute. So, okay. But then I can access it again.
Yeah. Yeah, you access it. Yeah, you access it, but it's just, it's not in your checking because it's a different account number than your mortgage account.
Yes. Okay.
When you pay your bills, you'll see your money go from your mortgage. Your balance will go up $5,000, go into your checking account, and then your checking account will pay your bills.
Okay.
So negative $5,000 in your checking account.
Okay, so money doesn't sit in the checking; it sits in the every night it sweeps to the mortgage, and then and then that's what your interest is accrued off of, where the mortgage account is.
Exactly. At midnight, it takes the calculation based off of what you owe, but your money's swept at 11:59.
Yes. Okay. So for I'm just thinking this. I just closed our loan 2 days ago. I have not received the checking. I have not paid a mortgage payment on it yet, so I'm still very much experiencing it. But I think, again, the value is we have money that we're going to be able to move into it right away, which will reduce our balance immediately. We have a bunch of equity that we refinanced it with already, so I'll get access to those funds immediately should I want them. And then again, each month I pay. If I need it, want it, whatever, you can pull it back out, or I can put it all back in there and leave it for however long. So the flexibility of being able to do what I want with my money is, because that's how that's what I see my equity in my house is my money, and it allows me to access it however I want, if you're responsible with it.
Like one of the cool things, kind of reverting back to what you were talking about a little bit ago about earning your money, paying it on a credit card, paying your credit card off at the end of every month. So and this is, I'm going to use really simple numbers, but let's just say somebody makes $100,000 a year or $8,300 a month. Now, let's just say that this person keeps that $8,300 in their mortgage for 75% of the month. They let it sit in there. Let's say they earn it on the 1st, they pay their credit cards off on the 22nd of every month or so. Ultimately, if they let that money sit against their home for 75% of the month, every month for a year, it is essentially like they are making payments on their home that is of a balance of $75,000 less than what they actually owe. They're making payments on a mortgage balance. Their interest expense is going to feel as though it's on a balance that's $75,000 less. So if they have a $300,000 balance on their mortgage, it's almost like they've paid about a quarter of it off every year. Yeah, they're making it based off of 225, not 300. So that's kind of like a really broad explanation of it. I mean, but that is also the math behind it. That's how it works so efficiently.
Yeah, and it compounds each month.
It keeps
Correct.
lower. Yeah.
Correct.
Because this is outside the box a little bit, and the way it was kind of explained to me, one of the ways for it to kind of meet legislation or be allowed, I guess, is it has to be paid off in 30 years. Your available credit and what you can pull off is for 10 years, and then for the remaining 20 years, it almost re-ams and turns into a 20-year loan, right? Is that
Explain
Yes, you still have so this is it is a 30-year draw period. However, you have access to the 100% of your line of credit. So let's just say your home balance was $1 million, or your value is $1 million. Your line of credit is going to be 800,000. So for 10 years, you would have access to $800,000. And then for the remaining 20 years or 240 months, that available line of credit is going to diminish by 1/240th. So in this scenario, instead of having access to $800,000, you're going to have access to $796,666.67. So it decreases by $3,333 every month for 240 months.
so that by year 30, should you keep this whole thing for year 30, you owe nothing and you have no more credit because it's all paid off?
Correct. I mean, and in reality, it's very likely that somebody would end up either refinancing back into this to have that extended, or at that point they sell their home and buy a new home and they're in a whole new property at that point.
Say I bought it normal 10% down. I don't have any equity yet, or credit yet. As I make a couple payments, my credit starts to climb up and my debt starts to go down, and I can use it at any time and it goes up and down.
Yes.
But even if I paid it all the way down, my credit goes up to say 800,000, right? We're using $1 million.
Yeah.
My debt is still this much money, so I haven't accrued. And then bucket 3 is when I start to actually pay it off instead of accrue credit.
Well, no. So you're actually paying it off day one, month one, depositing your money. Your balance on your mortgage is going down as you paying it off.
Okay.
I think by that last 20 years is really saying, hey, now you're kind of forced into this amortization schedule to be eliminated over this time frame. Obviously, if you paid your home off and you owe nothing on your home, well, you don't have that expense associated with the mortgage. Right. So now you're no longer going to a negative. Your balance is not going in reverse. It's actually going, every dollar you earn is going into the positive. So that last 20 years is kind of just that forced amortization.
I spoke with you at some point about using this product on an investment property. How many am I allowed to have? How many investment properties am I allowed to have on this product? What's my expansion with this product?
Depending on what route you go, since there are different investors for this product, obviously, one of them is okay, you can have more than one all-in-one product. The other one says, hey, no, you can't have more than one product. Right. So really, the way that I look at it is one primary, one second, one investment. Now, I think with the right compensating factors, you could most likely go, okay, great, let's do one primary and two investments. But at the end of the day, that's something that they would have to make that decision on. Obviously, primary and investment, you can have two. I have a primary and I have an investment in this product right now. Okay. So I know that can be done. Okay. I'm sure that going anything further than that, it's going to definitely take a little more granular dive into the whole.
Because that's what I love, what I think is so cool about this, to do it on a second, vacation home or whatever it might be, or an investment property. My interest in it is, if I have a investment property and I own it for a year and I pay mortgage down on it a year and it appreciates over a year, whatever it might be, and then, or 2-3 years goes by, and then I have a $7,000 air conditioning unit that I need to replace. I either go spend thousands of dollars to refinance my house and pull money out of it, or pay out of pocket or out of my reserves, whatever it might be. With this product, I can use my credit that I've built up from pay down to repair the unit. And so the property itself can actually pay for itself instead of out of my reserves or out of my operation account or out of my personal pocket. And so that was what was so interesting to me. And so if you've got one property that's paid down a ton, you can use its reserves, or you can use its credit to pay off, to kind of maintain all your other stuff. So you're not having to actually put in your own money or pull out of your own cash reserves.
On top of that, this loan changes the way your brain thinks about money. if in that scenario, you go and spend $7,000, you're feeling a $7,000 reduction in your assets, right? My balance went down 7 grand. Now, obviously in the all-in-one, you're still spending $7,000, but what you feel monthly is a payment of $40. So it's not going to completely demolish your profitability on the property. If you're renting it out for $1,500 and your mortgage payment's $1,000, well, now your mortgage payment's $1,040. Your payment comes into it and you put that money into it, that balance is going down, your mortgage payment's going down, you're building up larger, I guess, profit in that property.
Yeah.
Because that's, I'm just doing quick math on my phone. An average rental property hopefully cash flows you $200, two to $400 if it's a great one, a month. That's 35 months. It's over 2 years I'd have to collect rent to pay for that $7,000 air conditioner unit. Or I can use this property, pull it out, and it increases my cash flow, decreases my cash flow $40 or so because I'm pulling it out, and it increases my interest accrued. When you own a large number or more air conditioner units, go out more often, there's more vacancy more often, there's more repairs. And so if you've got something you can pull out, utilize, pay back down, built into a property, built into a loan, it helps out. The way I kind of picture my rental properties anyway is kind of like a piggy bank. Each month I'm kind of putting money into it, the tenant's putting money into it, government pay down, appreciation's putting money into it, and then one day I can refinance it and get that money back out. But with this, I don't have to. It's just I go get it.
Totally. And it even works so that somebody, if you ever come across somebody or anybody ever has the ability and they're fortunate enough to buy a property cash, they can do delayed financing on this product. And if it's a purchase or as a primary or investment, they can get up, go up from 70 to 80% available funds. And now that person can go, great, I bought this primary residence. Now I'm going to do this all in one on it. And I'm going to buy 2 duplexes. I'm going to put $200,000 in these 2 duplexes right here, put 50% down on both of them. And now I'm going to build, get 4 rentals right now and a primary residence all in a short period of time. And with the income of these rentals, it makes my interest and my mortgage payments and my interest payment. So I'm kind of no different than I was after, but now I've just, quadrupled the amount of real estate holdings.
Yeah. That's something I didn't mention on, but I think it's important when I talk to a lot of newer investors kind of learning the finance game a little bit. Most people, when they want money out of a property, they go refinance. And then it reamortizes your whole note, pushes it out 15, 20, 30 more years, whatever it is. And you're paying on that money forever, whether it's sitting in your account or whether you deploy it. And so with a line of credit, it's so much more valuable because you're only paying on what you're using. That's why if you got a bunch of equity in your home, don't go refinance and pull it out. Go get a line of credit against it. And then you're only paying on it when you're using it. If you're not using it, you're not paying on it. And so the cool thing is this is a line of credit and a mortgage. And so that's the value. Is most people, when they think about it, they're like, oh yeah, line of credits are better. You don't think about them a lot. HELOCs almost have a bad rap as being irresponsible. It's not. It's access to capital if you can use it properly. And you can deploy it and get a return on it based on what you're paying or whatever it might be. But yeah, that's where I thought if you can forget the idea of refinancing all your money, just get your line of credit and use the money as you need it when you need it.
Exactly. And the cool thing is, like, you can run your calculations. Okay, do I want to make this investment? I have a $50,000 opportunity. It's going to make me $350 a month. Okay, well, let's take your $50,000 out of your all-in-one, multiply it by, whatever your interest rate is. In this scenario, I'll just use 6% because it's just a round number, divided by 12. That $50,000 cost me $250 a month. Well, is it beneficial to make $50? Well, yeah, I guess you technically would. Numerically, it would make sense. So you could kind of use this to go, it's not something that I'm like, oh, this is going to be a good investment. It's kind of really simple math, and it's not magic. It's literally just a math equation. You do it on your phone and kind of start simple, but with something that's kind of relatively complex in terms of how it operates.
Yeah, that's kind of how I've always explained it, is with, again, debt, people are afraid of debt. A lot of people didn't understand it. And it's just kind of an arbitrage where it's like, okay, if this debt is costing me 5%, can I go get a return of 5% or more on it?
Yes.
If you can, it's good debt.
And even if you're not, for a short period of time, like right now, buying an investment property is probably going to be pretty break even in a standard mortgage. But values are, not climbing as fast as they were. At the end of the day, rates are not going to be at this location forever. I feel like you can't even say anything's going to be the same forever because everything's always changing. But there will be a opportunity, and when this property may make you money and may make up for that last year that you owned it, but now you have a new asset, you potentially got it for less than what it would have been worth 6 months ago. And it's not a short-term mindset, it's a long-term mindset. That's the thing that a lot of people, I feel like, think that they go after, but it's a lot of short-term thinking.
Yeah.
How long does it take to run quickly through a calculator on your website?
3 to 5 minutes.
Okay.
So everyone has access to this website. I'm going to be looking forward. Everyone has access to this website. Website's called allinOneLoan.com. And there's a lot of resources on this page, but at the very top of this page up here, it says calculate savings. This is the calculator. So if you go ahead and click calculate savings, it'll bring you to the very bottom of the page. And now you're in this interactive comparison simulator. You'll click this drop down and you'll just click start a new simulation. You can save codes and you can log in and create an account in the whole 9 yards, but we're just going to just start a new simulation, and I'll let you give me some numbers. I'll let you dictate everything.
All right.
So we're gonna compare this to a new loan, like a purchase, or are we gonna compare it to a refinance?
Let's do a refinance. Actually, nah, let's do a new loan. Sorry.
Okay. So approximate home value.
350.
Okay, and then we can do 10% or we can do 20% down.
Let's say someone's putting 10.
Okay. So they got a loan balance. So FYI, between 80 and 90% loan to value, as in 10 to 20% down, or 19.99, there is a mortgage insurance cost. It's a one-time fee up front, and it's dependent on what their loan to value is and what their credit score is, and there's a little legend or key that says, okay, if it's this loan to value and this credit score, it's going to be this. But that, I mean, it could range from almost 1% all the way up to almost 2%.
And that's standard with any
Correct.
under 20%, you're gonna have PMI.
Yes, but this one only allows for a single premium. In other programs, there are monthly options.
Yeah, okay. So it should increase closing costs slightly.
Yeah.
Okay.
Correct. So interest rate, we can go back 3 weeks ago to when rates were in the mid sixes. Okay, give me approximate monthly deposits. This is what this individual is going to see deposited in their bank account on a monthly, weekly, bi-weekly basis.
Whether it be income or whatever, just something I put into my account. Say I make let's call it 80. So I'm depositing $6,500 a month from income from me.
Monthly. And then let's just say that outside of this transaction, this person's got what, an extra 10 grand in their checking and savings?
Yes, yeah, I'd say yeah. Say I got 10 grand.
So ultimately, this repeating deposits is going to be the person's income and then how they receive it, how often they receive it. And then in this one-time deposit, it's going to be, oh, well, what other liquid funds do you have? It could be low yielding interest accounts. Like if they have a money market account that's making them 1%, it would make sense to take the money out of the money market and have it sit against something that's going to cost them 6%, right? Because it's...
I'd say most, and you do these more, so you tell me, most people, as far as liquid cash equivalent assets, I would say they probably just have a savings account, right?
Yeah.
And then, so let me ask this, the frequency deposit, if I'm a W-2, I probably get twice a month, right? How that would negatively affect it, right? Because I'm only getting half at the beginning, half in the middle, or would it be about the same?
I guess, again, it depends. That's where it's like, now we're getting ultra granular. It kind of depends on when they spend their money.
Right.
But yeah, it would make, if in an ideal world, if they got paid on the 1st of every month and they paid their bills off on the 30th of every month, that would be like the ultra efficient way of getting things done. Down here, there's an additional repeating deposits, an additional one-time deposits. So let's just say that this was a household of 2 and 6,500 came in from, individual number 1, and then the additional repeating deposits, you can go down here and add other sources of income. Oh, I have rental properties. I got rental deposits of $1,500. Okay, great.
Or my wife or my spouse makes an extra $3,000 a month or whatever.
Exactly. Yeah. Or it's like, oh, she does, or he does something on the side They sell some, yes, you can put all that in there.
Okay.
Or, hey, I'm going to get a big bonus in 4 months.
Yeah.
I'm going to get $25,000 in 4 months. You can do something like this.
Okay.
So I just remove that. So now this is kind of that screen where it really is important to know what your money left over is at the end of every month. So I'm just going to leave taxes and insurance the same at the end of the day. I'm going to leave whatever it kind of has in here. It says right here, hey, you spend $4,027 every month. If we go down here and say, oh, this person saves $1,600 a month, and it looks like they have a $2,400 a month approximate credit card bill. That's kind of what this is ultimately saying. I'm just going to run it with 25%. This person saves $1,600 a month. We can come back and fiddle with this number and see if it, what it looks like if we do less or what it looks like if we do more. And then we'll click calculate results. So on the left side, you have the individual that has the all-in-one. On the right side, it's the same individual, same income, same everything. They're just not using the all-in-one. So they're the same person. I'll zoom in a little bit. So ultimately, this individual on the left using the all-in-one is going to pay their home off in 9.3 years and spend a total of $92,000 in interest, have their home paid off, and have access to this line of credit of $315,000 for 9 more months. On the right side, you have the individual who is going to be borrowing $315,000 and spending over 100% in what they're borrowing in interest.
Okay.
So this person obviously is going to pay their home off in 30 years. It's very likely that this person ends up refinancing in 2 years from their 6.5 to whatever, 5.25, or whatever rates end up going to, but that's another $8,000 in closing costs, and it starts their 30-year time frame over, and they don't get out of this loop.
Yeah.
I need a refinance. I need this. I need that. Wonderful. And the crazy thing about this is that this scenario we're running is we're starting it off with an interest rate of 7.25, and we're running it at an average interest rate of 6%. And this ultimately is saying, hey, to compare this to a 30-year mortgage, you would need to have a 30-year mortgage at an interest rate of 1.798% to be equal to what the all-in-one's interest expense is.
Right. That's something you told me was, don't look at the interest rate, look at the money spent on interest. At the end of the day, if I have a 100% interest rate or 90% interest rate, but it's accrued on a significantly lower dollar value, I can actually spend less on interest.
Correct. I mean, 100% is getting wild, and that's the good thing about this is that the rate can only go up so high. It can't go any higher than a specific number. Or alternatively, again, 6.5 isn't the worst rate on planet Earth, but it's definitely not something historically we would consider attractive. Mm-hmm. And historically, I mean in the last 5 or so years. But comparatively speaking, you would need to have your all-in-one, again, we're running it at 6%. It would need to go to 12.3% to be equal to a 6.5% 30-year mortgage. So it gives you both sides. Mm-hmm. You need your 30-year mortgage to be this, or your all-in-one needs to be this to be equal to that.
All-in-one is simple interest accrued daily versus compounding interest in your 30-year mortgage.
Exactly. So if let's just say that I think that interest rate was like 6.01. So the way that the payment's calculated is this is your balance today, and then we take multiply it by the interest rate and we divide it by 365. So your payment today based off of that balance is $51.86. And to kind of get a little more in depth about it, this is kind of that same scenario. So I think 6.01. Ultimately, this right here is saying, great, you have a loan balance of $13,000. And let's just say that this person gets paid, what do we say they made $6,500 a month? So let's just say they get paid on the 1st and the 15th, $3,250 here and $3,250 here. As this person earns their money, their payments going down. So when they earn their money, their mortgage payments, that $51.86 for this amount of days until they earn their next set of income. And then at that point, that next payment is going to be reduced. So they are saving almost $1. Well, from here to here, it's $1. Yeah, it's $1. But that adds up over time. I mean,
Right.
you can see their payment down here is at $15.32. If they didn't earn any money, $15.56. But that adds on top of each other every single month. Allows for that person to save $30 this month, $60 next month, and then the money saved every single month gets added on top of it even further.
Right. Which is what allows you of across
9 years, or however many years it said on that calculator, to pay off your $315,000 mortgage.
Exactly.
daily you're saving a couple of dollars.
Yep. And then, there's variable options in this program. You have an adjustable loan program. You have a 3-year fixed that has an introductory rate that's between 0.5 and 0.75 lower than what the current interest rates are. And then there's a 5-year fixed that just locks the loan in for 5 years.
Mm-hmm.
And then, so I think mine was the 3-year fixed. I had that rate, and my thought was in 3 years, hopefully rates are lower, so my margin might actually fall instead of increase. Or with the margin, it might be the same or fall.
Yeah. So by choosing in your scenario, I mean, let's just say that this person ended up doing that. They did the 3-year fix. They bought this margin down as far down as they can. It was a 9.3-year payoff. Well, now it's going to be a 7.7-year payoff. So by doing that, this hypothetical person saved something like 30 grand in interest.
Yeah.
In 2 years.
Yeah.
And so after the fix goes away, it adjusts monthly, or it adjusts monthly? Okay.
It adjusts monthly.
Yeah, okay. And it has a cap, has a ceiling, and it has a floor.
Yep. So the ceiling is 6% above your initial start rate, and then your floor is going to be 3.75.
So in this instance, it'd be 3.75 to 12, basically.
Correct.
Okay. Yeah. And even the calculator you showed just a minute ago, the rate assumption, or I can't remember what you clicked on, but it said even at 12%, it's the same amount of interest paid as your 30-year.
Correct. That's 6.5. Correct. Now with this whole scenario with using this specific rate term and this margin, it's actually going to change those numbers. So now if I click this pay down summary, it's as if you have a 30-year mortgage at 1.2%. Yeah. Or you would need your all-in-one to go to 17%, which again, based off of our conversation, is physically impossible. The high it can go in this scenario is going to be 6 above whatever your start rate is.
Yeah. Yeah.
Which will, in this is like 11 and a half or something like that.
Yeah. That's
kind of the breakdown of this, and along with my really rudimentary calculation on a daily basis.
Yeah, this you showed me this, and it helped me out a ton because I wasn't grasping the daily assessment and then accrual of interest. And so that's where the idea is: put as much money into your account throughout the month as you can, delay what you have to pay as long as you can, right? And that continues to reduce what your interest buildup is. And then if your payment stays the same, then your interest is lower, then your principal amount is greater, right? Theoretically. So
exactly. Yeah.
Yeah.
And I can throw this out to, years and really run a really detailed number to show you exactly. The all-in-one simulator does this, but instead of doing it on a daily basis, the math behind it, I believe, does it on every 2 weeks. So it runs it out like that. We're developing a more in-depth version of this that allows for you to kind of manipulate everything, calculate it on a daily basis, and get you really granular.
Yeah. Okay. What else? Anything else we need to know about this product?
This loan obviously has some unique qualifications for it. It follows the same underwriting procedures at the end of the day of a conforming loan, but we want to see in a refinance an equity position of at least 10%, hopefully, beyond that, so we can avoid that mortgage insurance cost to that 20%. Debt to income ratios need to be below 43, preferably below 40%. And the reason why I say that is the final requirement is outside of what you have in equity in your home. We would like to see reserves of between 10% to 15%. So your debt income ratio at 40% or lower, we'll have 10%. We need 10% in reserves. If it's between 40 and 43, we'll need 15% of your total line of credit. So if somebody has $1 million home, $800,000 balance, their line of credit, but they owe 100 grand, we need to take 10% of the $800,000 line of credit.
Okay, that's good. And then closing costs, you've got some point buy down options and different stuff like that. Was the closing cost seemed a little higher than what a traditional mortgage might be, but not cumbersome? Is there anything additional? Same thing, you get the appraisal. Anything underwriting wise or transaction wise that might slow down a purchase if I'm buying a house through it, or anything I should expect through a purchase?
So the closing costs kind of vary depending on the program you choose. There's that monthly adjustable program that we saw. The 3-year fixed actually is kind of the more expensive of the lot because you have that introductory rate that's substantially lower. The 5-year fixed, I mean, all of those, most procedures you end up seeing are going to be, most loans are going to, you're going to see people quoting 1%, which that's the monthly, and the 5-year fixed is going to be pretty in line with that. Now that 3-year fixed is going to have slightly more cost because you are getting that introductory rate that's locked in for those 3 years.
Right. Yeah.
Underwriting wise, there's some uniqueness with rural properties, no manufactured homes, but really just don't get crazy with running your credit and doing anything wild during the transaction. If you're going to refinance, don't list your home while you're in the process of refinancing it. Wait until after if you decide to do it. But nothing that's standing out like crazy.
I think, what was Emily a processor of yours, or was she like a liaison?
She's my production.
And she did a great job. She made a difficult, annoying process easier just because of all the stuff. I mean, anyone who's bought a house understands all the stuff underwriters need. So
thank you for sending us that blood sample. I know that it was
yeah, I'm glad you guys got it. So let's transition. I'm sure I could talk for hours about this all in one. It's a super, super interesting product. Let's transition into another thing you guys are doing or working on building out, is something we're talking about, and it's essentially an opportunity to buy down rates on properties where we might have some price drops. It's specific to builders, but it allows you have to create entities and do stuff like that. So kind of tell me a little bit about who's it for, what's it for, and how does it work a little bit?
Yeah, ultimately it's for the consumer at the end of the day to help assist them. Most people just automatically assume the lower the rate, the better the payment. Yes, and to some degree, but in this scenario, we're really trying to take the rates that we have right now that we're all kind of forced to go through and really reduce it. Mm-hmm. And the way we're reducing this, and this is the scenario that I ran and kind of drew up last week, so numbers might be a little bit different, but this is just a hypothetical. What we ultimately are doing is working on trying to say, hey, builder, don't reduce your purchase price on your home. Let's actually find a way for you to contribute in a legal way to the buyer to buy down their interest rates substantially more than the ways that you can currently contribute to the buyer. Mm-hmm. So in this example, I said, hey, let's have this builder hypothetically that's selling their home for $600,000 reduce the sales price to $500,000. What's going to be better for the consumer? Well, if you're just looking at just reducing the sales price and not influencing anything on the interest rate, then obviously your $500,000 is going to be better. But what I'm trying to say is, hey, let's have this builder not reduce sales price and go, let's get $50,000 in a way that we're able to reduce this interest rate for the buyer. Great. That means we keep our value at 600, so we don't mess up comps in the local area. We still make our $50,000 and we're contributing it to the person so that thinking down the road, this person's going to get a low interest rate. They're not going to need to refinance in 2 or 3 years whenever things start to kind of shift in a more positive direction. Right. So you're kind of saving them money in that aspect. But by utilizing this individual is able to buy down their rate to 3.75 as opposed to going that $500,000 purchase price, doing their 20% down and having rates at 7.25. And by putting their payment on a 3.75 interest rate at a $600,000 purchase, their principal and interest was something about $2,504 a month, as opposed to that lower purchase price, higher interest rate. Their payment was $2,729. So it's saving them $225 a month to take the higher purchase price.
Let me recap this a little bit.
Yeah.
So, option one is you buy it at the new price drop. He drops it down to 500K, and you get today's rates at 7.25. Or you go back up to his purchase price, his or her purchase price, and the builder contributes money towards your rate. So you're paying more, but your rate is potentially 3.25 points less. And you're actually going to save $250 a month by paying more with a lesser rate. So that's something we've all been seeing. Tons of people have been seeing posts on Facebook about how the rate is so important and all that stuff. And price can go up 50 grand, but it only changes your mortgage a little bit. Rate goes up a point, changes your mortgage a lot, right? And so this is an option where give the builder what they want and get a significantly reduced rate and actually have a lesser monthly obligation.
Exactly. Yeah. So, I mean, in this scenario, this person would be able to say, okay, great, I understand that I'm buying it for more. Yes. But I think that allows for several positive things, from the very simplistic route of agent commission gets to be off the higher number. Great. Right. That's kind of a win, which is not always the best win, but it's a solution nonetheless. And even more than that, you're not then seeing these builders that are maybe building 20 or 30 homes around your house go from 600 to 575 to 550 to 525 to 500 and have your home value go right along with it, because those are going to be the most recent comps when they sell, because those are new built. So now you're watching your home that appreciated from 480, 450 up to 600 go back to 500.
So this is not something that any seller can do. It has to be a builder, or has to be an entity. If there's an entity, an LLC selling a flip house or something, would that?
Okay, builder.
I think it's builder directly.
So it has to be a builder. There's some paperwork that has to be done on the back end to make it all legal, because there are laws. What's the law that?
Yeah, they're just interested party contributions. There's different percentages depending on down payment that the individual is utilizing. We're looking at trying to find the appropriate way of getting around that
legally.
Yes.
Legally, yeah. So that is it something where a builder could come to you guys and say, I don't want to cut my price. Let's figure out a way to keep my comps the same, but I'm going to contribute 10 grand on every price towards a rate lock.
Well, they can do that already, though, at the end of the day. I mean, if they're buying a $350,000 house times 0.03, then it's $10,500. They can already do that. We're trying to go
40,000. Okay. So you're trying to push it beyond that 6% limit, and that's where you can start to provide value that other banks can't.
I mean, even at that higher percentage interested party contribution, that requires the person buying the home to put more money down anyways. So that's where it's like, again, there's a graph and we have to pinpoint which one they are. Okay, this is how much they can have.
Okay. So hypothetically, in a $350,000 price, sellers can't contribute more than 6% if they're putting 20% down. So they can't contribute more than $21,000. So say you found a new construction house that's dropped their price by 40 grand. Mm-hmm. This would be an option where you could give them their original price and ask for that $40,000 margin to pay down your rate down from a 7.25 to a 3.75 potentially. We're making these numbers, but a meaningful.
Correct. And that's, I mean, the incentive behind it is if the person's already under contract at that higher amount, the builder is going to go say, no, I'm not going to do that. You're already going to let's incentivize people to buy our property. So yes, it's there's a lot of other things that need to come into play, and interest rate isn't the only thing. At the end of the day, it depends on what that person's goals are. There's times where I've had people go, I don't want to spend a dime on my interest rate. In fact, I want to take an even higher interest rate because I'm going to be in this house for 12 months or less, or I'm going to buy this place, flip it in 6. So I'm going to take a higher interest rate and get a little rebate back and, pay an extra $100 a month, but I'm not going to spend $7,000 at closing because I'm only going to keep it for 7 months.
Right. Okay.
We're in Oklahoma City. you deal in more markets around the country. Oklahoma City, our average new construction is probably in, like I said, the $350,000 range. If you're dealing with new construction in the $700-800 million range, you probably are seeing 20, 30,000, 50,000, $100,000 price drops. Where this can be used. So really, it's got to be a position where price drops are more than 20 or 30% to really start to be valuable, worth going down that process. Okay, good. Wanted to segue back into this last thing, something we had talked about a little bit, the Home Funded program. I think you told me about. So tell me a little bit, why is this interesting product?
Ultimately, some of the large hurdles associated with buying homes is going to be your down payment. If not, that's like the main hurdle. And we've actually been able to, in conjunction with Fannie and Freddie, crowdsource down payment to where you can go online, you can type your story. It could be the sob story. It could be, oh my gosh, we just got married, we're having kids, we moved in together, I'm graduating college. Could be anything, really. You create this website, people can go on there, your grandma, your neighbor, your neighbor's grandma, whatever. It doesn't need to be somebody you even know. And at that point, they can contribute money, and CMG will contribute funds 2-to-1 up to a specific dollar amount. And then even more, the agent and whomever else can contribute funds as well to help with this down payment. That down payment obviously could be your 5%. If you had a really amazing, compelling story and great marketing, you could get 25% down. And it just allows for people to say, hey, I'm getting married or whatever. Don't buy me a toaster. We got 3 of them. Just give me $100 so I can buy a home. Yeah. Perfect. That's awesome. And it just allows for people to crowdsource. There's even a deeper kind of storyline behind it where you can actually communicate with businesses like large entities that something like 2% of a working population will buy a home every year. And we can actually partner with a hospital, we can partner with KFC, whoever, with their benefits team, their HR team, and their employee retention teams at the end of the day and say, hey, you're going to contribute money, the agent's going to contribute money, the lender's going to contribute money, and they're going to be able to post it online and make money themselves. And so that this person can buy a home near where they work. And if you get it, if for example, let's just say you found a local hospital and there's 4,000 employees at this local hospital. Well, then that's approximately saying that there's 80 people in that hospital that will buy a home this year. And if they want to use this program, they have to use you. And if the average sales price is $350,000 and you're getting 80 people, you just did $28 million with just this entity, and it's 2% every year. So you get approximately $28 million every year. And if you had to give up 1% of your commission and even just say, to contribute to the individual, and let's just say you made 1.75% just to throw in, any type of fees or whatever else is going to be involved. Well, now this person ended up just making almost $500,000 just from this connection. So it's even more ingrained than just one person. You can partner with entities.
Okay. So tell me about the matching part. You said CMG gives up to 2-to-1, up to a dollar amount. Yes. So if grandma gives me $10, CMG gives 20?
20.
Okay.
Yes. And so the thing about it though is
up to,
I believe it's $2,000. Yeah. I remember that's the last time I was looking at this program. I've had a couple people do it, but they're still going through their procedure, I guess. Right. They're getting funds donated. The money that we contribute does not get deposited into your bank account.
Right.
It gets deposited into its own entity, but the money that does get deposited to you from grandma or whatever will get deposited into your bank account as part of the, the seasoning requirements that we have to have with this. Freddie allows for something a little different. Fannie does need to require seasoning. Our contribution is just going to be seen on your settlement statement. So we're not going to give you $1,500 so you can go, sayonara, I was never actually going to buy a home.
Yes.
Large employers can do this as a retention or benefit product.
Any employer can. It could be an employer of 20 people.
Okay. Yeah. So it's something where you can just approach an employer and see if they want to partner with it, where it can give their employer some of just an additional $2,000, $4,000, $6,000 towards a house potentially.
Yeah, and the benefit for the employer is it costs a lot of money to train somebody, and it costs a lot of money to make sure that that's the right person that you actually want. And if you don't get the right one, you do it again. and people are more likely to stay with the company that helps them buy their first home or their second home. And anybody, you can do this 9 times. I mean, in reality, you can do this right now and go buy an investment property.
Yeah.
Get
Yeah.
a gift from us.
Yeah, because that's where, because, you know, we've all dealt with, or I'm sure a lot of agents have dealt with gift letters where grandma gives you $5,000 and we write a gift letter and it doesn't have to season or anything. But this is a way to kind of crowdsource it a little bit, not if you don't have a rich mom or grandma or something, right?
I mean, it works. It works well because if mom's going to give you $5,000, then great, give her $1,000 through this application, and then give her another $4,000 outside of it. Let us give some money.
Yeah, and then it's money out of you guys, and yeah, absolutely. Yeah. So interesting. So is this kind of like the builders where some entity has to be set up, or is it just through any crowdsourcing website they can create, or is it a specific crowdsourcing?
No, yeah, it's called Home Funded. The website is.
Oh, okay, so it is Home Funded.
Yeah, I believe it's homefunded.com.
Okay.
Now you go there and you can, how it works, closing cost grants, success stories. There's some frequently asked questions. Yeah, $2,000 closing cost grant. Earn up to $2,000 towards your closing costs. Match down payment gift, $2 for every $1 received. Plus, get bonus dollars when you shop and share. And the shop and share allows for people to go shopping wherever they go shopping: Lowe's, Home Depot, Walmart, Costco, you name it, Target. And then by utilizing that and utilizing this person's code, funds can be contributed to their account from your purchases. So it allows for, places that you're already going to go. Why not contribute to your son, your daughter, your grandson, your neighbor's son, whatever?
That's interesting. Yeah, crowdsourcing down payments is an interesting. I like that. I like being able to legally. Yes, legally. Yeah. Well, the bank. I mean, yeah, the bank's gonna ask where the money came from, and so if it's not legally, you're not gonna be able to use the funds.
Correct.
Well, that's awesome, man. Yeah, that's what I mean. As we, I was kind of joking with you on the phone the other day about this. You guys have some interesting, cool, innovative products. They just take. You have to understand them, and they're outside the box, and so you have to understand why are they doing this. Okay, it's helpful, it's great, and so if it takes more than 20 seconds to explain, people are like, I'm already checked out. I'll just do whatever everyone else is doing. So that's what I thought, if I can kind of share this and get it in front of people. And like I said, one of the main reasons I wanted to share it with people is because I've been looking into it for a year and finally did it personally on my own. You have it on 2 properties as well. So maybe this whole thing stinks and in a year I'm going to refinance it. But for right now, it looks awesome. It's been awesome. I'm excited to run through it and get it going and see how it all plays out over time and pays down. The way I plan on using it should pay down. My calculation was like just over 6 years.
So we'll talk in 12 months from today.
Yeah. Yes.
We'll go through it,
follow up,
and we'll see how it is. Worst case scenario, I get a refinance out of it.
Exactly. That was always been my number one thing. Is like, I'm lucky enough to have a bunch of equity. We did some stuff and have a bunch of equity on our home. So if it stinks, I'll refinance out of it. And that's a great. If it's some money down the drain that we may have lost on the thing, but if it stinks or it's a terrible whatever, but it's not, for so far it's been great. That's always been my worst case scenario, right? I can pull the ripcord and I can get out of it if I want to. But like I said, it's so interesting if you can understand, like I said, in the investment world and the finance game. And when you're investing, you need capital. It's a capital management issue, right? How do I use this funds for this and get this money back? And you're allocating funds, and so there's a great tool for that. And so I'm excited to utilize it. So I think that's all I have for you. A couple of really cool things. I am going to share your information here on the bottom of the screen. Hopefully the editors will do that for us. And then obviously we'll share your information. Anyone, how can they get a hold of you? Just tell us, email, phone number. How do you want it to be reached out to?
Email, text, carrier pigeon, whatever mode of transportation you have access to. Emails are easy, texts are nice. I don't like notifications, so if you call me, leave a voicemail, because I will get back to you on that. If you call me, I just assume it's another spam call.
Yeah, I'm the same way.
Yeah, so however is the easiest way for you guys to communicate, that's for me. Harrison@cmgfi.com.
Harrison@cmgfi.com.
Awesome, man. Well, I appreciate your time. We've been talking for over an hour here, and I could talk about this all day. This is super.
I'm actually 100% the same boat.
So, very much appreciate it. And we'll tell us the all-in-one calculator website again.
Yep, allinOneLoan.com, and then home funded is homefunded.com.
Easy enough. Holy cow. Okay. All right, man. Well, I appreciate your time, and I appreciate you jumping on here and talking about it with us.
Thank you, Brett. Appreciate you guys.